Ladies and gentlemen of the crypto space, we're live on a Wednesday, April 3rd at 12:17 p.m. I like this image. This image, not. Well, how else am I supposed to say it? Calm down. And even if you want to engage in highly speculative activities in a wallet you didn't control, you want to be calm doing it. You want to be justified with data, substantiated with information. You want to make data-driven decisions. Now, you could also consider data such as statistics, odds, probabilities, and really you need to get into social metrics, measurements of social activity, if you want to do certain types of activities, particularly with coins that have no function, no utility, and aren't a business, which you can do, but be data driven. And the last thing you want to do is have an emotional response to content you see on social media. You could use it to guide you somewhere, to see some data. And the most important thing is any data that you see, you need to understand. I need to inspect it for yourself. And you need to come to your own conclusions. And if you're not coming to your own conclusions, you're doing yourself a disservice and you're going to harm yourself financially, which means you need to start wherever the fuck you need to start to build a foundation of knowledge. And it doesn't have to be the shit that we talk about with regard to macrofinancials and the degree of financial enterprise and infrastructure that we so often discuss. It could be lower level or less sophisticated, such as social media metrics, mentions, the amount of activity on X is probably an adequate amount of information to assess the potential volume of engagement with meme coins. And if that volume of engagement is increasing, find the charts. You could get charts and assess it. If there's 100,000 people talking about a meme coin today, 200,000 people talking about tomorrow, 500,000 people at the end of the week, if the holder count is increasing over time, okay, at least you're making a choice rationally. A very irrational environment, but at least you're engaging with it rationally. You can very much engage with left curve narratives from a right curve perspective. And that's just something very important to consider. The most important thing is to tame the Hulk. Calm down, chill out, keep on cruising. And then eventually you get to a couple of cycles down the road. You've accumulated some wealth, hopefully cash flow productive wealth. And then at that point, you don't give a shit about chasing hype. You don't care about the hyperbolic narratives. You don't need it. You don't want it. It's a waste of time and it's a waste of energy. And you realize the significance of it in this landscape, especially where things are heading. People think, at least the early participants and the new entrants to the space, think they need to rush into things. They need to be quick on the trigger. They need to get somewhere fast. I mean, it's the same fucking psychology we deal with on highways, rush hour, and the degree of incivility that people experience, cutting people off, tailgating, everyone's in a rush. There's something that's meaningful and being calm, introspecting, thinking before acting, being in touch with one, yourself, and two, the rest of the goddamn system. That's not just a system of economics, a system of humanity, a system of, some call it nature, some call it the universe, a system of biology. And this is what like the monks talk about in very Asian type of philosophies. It's not even just Asian. It's any of them uh, very robust philosophies that involve meditation, being in touch with yourself. Touch yourself. That's not what I mean. And you want to build that richness. Literally, I'm talking to, I fear, like who I was in my 20s. And I know there's a big audience for that. I know a lot of people produce content like that, but you're listening to a 40-year-old man, 41 years old with two kids, and I would hope that people can make decent decisions to head down a similar path as myself, to find calm, cool, collected in a sea of insanity. And that's kind of why I tell the stories. To me, that's important. And it helps me understand and further get calm and rational and data driven. I mean, it's something I've talked about in software development for over a decade. Be data driven. You need analytics, otherwise, you're making shit decisions. So, isn't that even more so the case with regard to financials? I wanted to talk about. I don't know, everyone's still hyped up about meme coins, and everything reduces to multiples. 10x, 100x, 1000x on the money. And I've talked to everyone's ears until they're bleeding about position size, and it's somewhat. I kind of want to go back to macro because I think people don't yet understand what it means and how big it is in a very short time horizon, and how the structure of the system is changing, and they're engaging with this high risk activity because they don't understand that they could actually engage with medium to low risk activity and potentially actually achieve many more benefits and much better returns, much better performance, much better results, because they don't understand what these systems are and how big they're very likely to be based on just odds because of what they do. And we've discussed the rationale of why what they do is something very significant structurally to the financial system in a perfect time when the financial system desperately needs these types of products. And they're going to seek out these types of products because they're better. That's what everyone does when you go to buy a technology. You buy the shit that's better. And that's exactly what the systems that we talk about are. Um, I guess I want to give people a scale and scope. That's the most important thing. And there's plenty of meme coins that are very hot, and that's cool, and that's okay. Just you want to come out of this cycle with more money than you went in. So the odds are you won't if you engage in a non-thought out, data-driven process, a non-data-driven way. So let's try. Let's try to be a better you. I try to be a better me, and then we could have a very different conversation in the coming years. Just like this conversation we're having today is very different as compared to 2021 when we started these conversations. You can imagine the conversation we're going to be having in like 27 and 28. 27 when markets start to bottom after whatever catastrophe is coming. 28 when things start to fire up in the money printers around the world. It's coming. So that's the analogy I always tell you folks about trains, railroad tracks, and stop throwing quarters at railroad tracks because the train's coming. The trains, plural, are coming. So all you need to do is put quarters on the railroad tracks, and all you need is one of them to hit. And that's the same psychology as getting a good run on a meme coin. turn $100 into 50,000, $100,000 or more, and that changes a lot. And that's the philosophy, or at least what I talk about in regards to 1% of the portfolio, 10% changes everything. 1% of the portfolio to 75, 80% of the portfolio, or doubling the original portfolio size. Now you're talking about recomposing what you have, the wealth that you have, the assets that you own, the businesses that you own. And the odds are much more in your favor that that's going to happen over time rather than trying to force it to happen today. It's monumentally not in your favor to do it today. Because if you do it once, if you get a 10,000x on $50, $100 lunch money, the odds are not that you're going to do it again, and you're going to probably try and do it again. So at least you want a methodology. If you have a methodology that you did the first time to get that 1,000x, 10,000x, at least you have a methodology to attempt to execute to try and do it again. But you don't really need it. The world is going to end up in a weird place, and that's what story I've been trying to tell for the last couple of years. It's so eye-opening and startling. This is the dollar index, and basically, if this doesn't go down, the world is in a very precarious place, which means war and violence, which means it doesn't matter necessarily if you have money, which means the odds are this goes down because most people won't vote for war. We may end up in wars, but war is usually attempted to be avoided. And even if you have war, they're still managing the currencies. They can shut people out of networks like they did in Russia, but they still need to manage this. And this is a managed chart of the dollar versus primarily the euro and the yen. And those are allies. That's the bottom line. In many regards, that means everything. So this chart needs to go down, otherwise Japan is in a very precarious situation, and they're a massive ally in the East. And we have a lot of things going on in the East. And fuck, Europe is Europe. If Japan's currency blows up, or frankly collapses, this is an inverse chart, this is dollar verse, then they don't have an economy and they fall into chaos, then you don't have an ally. I mean, literally, this chart is literally existentiality for nation states. This chart goes up to where we were, literally just where we were. We're talking about utter chaos and failure of nation states. So that's why this chart must go down. And the doom and gloomers say it's going to go up. I don't want to see war. I want to be optimistic that we're going to avoid war. You don't bet on the end of the world. You don't bet on World War III. You don't bet on the collapse of markets where people will be suffering and retirement funds evaporated. The 90-year-old guy that has a 401k and a pension plan that's completely dependent on the S&P 500, and the S&P 500 collapses 50, 60, 70%, whatever disgusting number can potentially happen, and their retirement savings gets wiped out. It's a humanitarian catastrophe, and that's not something I want to bet on. I want to bet that politicians want to get reelected. I want to bet that the system wants to protect a capacity for a retirement age population to stay retired and not die and not be on news media suffering. That's what I want to bet on, that the world wants to do mostly the right thing in the grossest of ways possible, and we could all accept that the financial system is perverted to all end. It's broken. But the odds are that these systems will be protected. It was literally the definition, or at least the way Keynesian economics works. It's designed to intervene and to smooth out the business cycle. We haven't had a recession in 15 years. And then there's a reason we haven't, because they've been managing this shit, and they've been doing a good job. Isn't that a contrarian take? They've actually been doing a good job managing the economy, because that's the whole point. They've literally taken the economy to the full extent of Keynesian potential. You've disrupted the business cycle artificially using fiscal policy and debasement of currency. And that is literally what gold is screaming. Oh my God, that's quite remarkable. So you got your currency, and currency is relative. So it's relative to what other currencies are doing. And that's a game of one geopolitical phone call versus another. But gold obviously pierced through everything, and Bitcoin as well to a degree. And arguably, this pierced through it much more comfortably. This is the slow old horse in the game. Now, this is doing this. Something's changing. This doing this just further solidifies my perspective that it's going to get weird. And we could talk about what that means. It's going to get weird. But I want to show you the US 10-year as well. So let's zoom out to the yearly. So it's going to get so weird, guys. The scale and scope of the system, the U.S. calls it the rules-based order, and that basically means the status quo, where the U.S. runs the seas, the oceans, they protect the oceans, and that's changing. And, the globalization trend is changing. This chart, best expressed in logarithmic form, basically depicts a structural change in the system. And frankly, this chart and gold doing what it's doing right now is literally just further confluence. Now, it's taken 2 years to see this kind of data, and that's the amount of time it takes to really get confirmation or have increased confluence that something's going to get fucking weird. And frankly, it's already getting weird because these things are getting weird. This is weird, and then gold weird, and that's confluence of weird. So what does weird mean? Weird means probably things we expect. So over the last 50 years, disparity has raged. The poor are starting to get handouts, and they're doing better because of socialistic programs. And the middle class is hollowing out, and the rich get richer because they own everything. So what does other nation states in history tell us? What is it in India yet? You're either poor or rich. There's no middle class. And this is the tendency for all nation states to head in this direction. Now, what people get wrong also is the time frame involved. Let's say over the next 20 years, the middle class shrinks by another 10, 15, 20%. Okay. That's heading in the direction that we've been heading, and it's just going to get worse, worse, and worse. And it's just a continuation of everything we already see going on. And what do we know about data and charts and structures? They operate in trends and cycles. And things continue until they stop and reverse. So what's going to stop disparity? What's going to reverse it? Policy? Taxing the rich? Fuck no. Trend's going to continue. But it's also going to be different. Trend's going to continue, but the middle class is going to get hollowed out even more and even more. People will continue to slide into poverty. Inflation should trend upward over time. It won't be at 0, 1% or whatever the hell it was with the 2010s when globalization basically allowed us to do what we did and have the system we had. If inflation does what it's going to do, that's where the middle class goes bye-bye. And asset prices, because the currency is a relative game, they need to balance it. And it's all a fiscally dominant regime. That's literally by definition the situation Japan's in. And that's the conversation that everyone's having with regard to the United States right now. that it's in a fiscally dominant situation. And fiscal dominance means they're going to need to lower interest rates merely to accommodate the amount of debt and interest payments that the federal government has to pay out. Otherwise, if interest rates keep going up, the debt payments just will hurt the capacity for the federal government to pay for its obligations. And then people don't get reelected. And they want to get reelected, and that means they're going to spend money. So all this is going to head in a very reasonable direction. It's not going to fall apart, at least other than for a transitory period of time. Asset prices will continue to inflate, but I think that's going to get weird. Weird means that asset prices, I think, are going to diverge significantly to the upside, especially in these emerging markets. Banks are less and less being significant in the money creation process, commercial banks especially in the US, obviously. Lending and borrowing at these interest rates has ground to a halt. The balance sheets are impaired and constrained. The banks are going to be turned into bond recyclers, treasury instrument recyclers, and they're going to use the commercial banks instead of the Fed balance sheet for, quasi QE or best said monetization purposes, and possibly management of the yield curve such that there is remotely favorable conditions for commercial banking to continue to exist. And all of this will occur in an elevated interest rate environment because internationally, they can't just go full Japan and buy everything. And then, there's no organic system that remains. So you still have they still want to sell most of the instruments internationally, so they're going to preserve the relative organic behavior of the system. But how do yields trend? Yields should logically trend higher. So my expectation is higher lows and higher highs on interest rates with intervention, cyclical intervention, to manage those interest rates in a way that allows the United States to not blow up its debt and continue to do what it does fiscally and politicians to get reelected. So these elevated interest rates do something very weird. It's as simple as that. 3.5%, 4%, 4.5%, whatever they get to in the Fed funds rate. That whole narrative, man, that whole narrative in 2022 about when cutting of the rates, like it has anything, especially now, anything to do with a bullishness in the market, is so off base with the mechanics of the system. It's startling. Everything runs on incentives. Everyone's behavior runs on incentives. So if you're a banker and you have a capacity to loan and you have a rule that someone needs to post collateral to borrow money and you're getting 0.25%, and now finally 2 years later after 2022, the bank's balance sheets are freeing up internationally. And the heads of the departments are saying, all right, we got some capacity. Go ahead and tell your clients, get your collateral ready so you can borrow. And to top it all off, the bankers, the management says to the banker, just think of like margin call or some sort of, hyped up scene where the manager's saying, get on the phones, go make some money. But now the bankers have, instead of 0.25%, they have 4+ percent. And when you get your money on bonuses. So if you're going to issue a 4% loan on $1 billion versus a 0.25% loan on $1 billion, big difference in bonus, big difference in cash payment to the financial institution creating those dollars. So I think the incentives are going to produce some weird shit that we haven't seen since maybe 2000, late 90s, leading into the tech bubble. With regard to currency expansion, and the mechanics there are the bonds that they have to print in the Treasury Department this year, $10.8+ trillion. There's your collateral. So the bankers internationally are saying, give me collateral. There's the collateral. It's going to come from the Treasury Department. And why are people going to buy it? Because they're going to take their $1 billion worth of collateral from U.S. Treasury, go to a bank in Europe, and the bank's going to say, all right, we'll give you 4-to-1 leverage or some shit like that. And they're going to accept the collateral and give the dollars into a deposit, and that's the money creation process. And that's done on leverage, multiples of the 10.8 trillion, because that's as good as cash. It's a cash equivalent. At maturity, the United States will pay the face value of that collateral that was posted for the debtor to take on credit from the bank. So this is how the money gets created. So what do we know about money? We look at the amount of stable coins in crypto markets quite often. So the way that works is if there's more dollars in a particular market, broadly speaking, there's more opportunity. That's why I love this page. And it really tells a hell of a story. So if there's more dollars on the planet, how much more dollars? What, a 10, 15, 20, 50% increase in dollars, wherever the hell it lands in 24 and 25? What are the dollars going to do? They're probably going to chase the same shit they always do, but the crypto space has been becoming more interesting, more of a palatable destination for capital. Didn't exist prior to 2020, and especially in the particular way that it exists right now. So at the margins are what count. What does that mean at the margins? So if 1% of the printed capital in 24 and 25 head into the crypto space, $1 trillion? 2 trillion? 2%? 5%? 5 trillion? Do you see how many billions of dollars there are in the crypto space? $152 billion. So the scale and scope of what's coming is completely ignored and not understood by the majority with regard to the expression of activity that is going on in markets. Folks are engaging with markets right now like this is all there is, and they need to get in and out before it's over. And you're going to look back in hindsight and realize there were a lot of businesses that could have been bought. Businesses maybe akin to owning an Amazon in 2001 post crash. You know, things bottomed out in 22 in the crypto markets. So things bottomed out in 2001 after dot-com bubble. Discount and the premium. If $2 trillion fall into this market, and that seems quite tame, that would be an extraordinary appreciation of you wouldn't folks would be completely sidelined. They wouldn't understand it. But that's exactly why we talk about this conversation, to understand the mechanics of the system, which could lead to not just normal appreciation, not just repricing 100%, 1,000%, 10x on the money. Things will get weird, more likely than not. We're talking about hundreds and hundreds of X's on things that are just commonplace. $10 million protocols going to $1 billion. My general expectation, to try and express where I see things heading, top 100 double-digit billion market cap. That's going to be weird. And that means the time is now to own these businesses. They're going to run 100x on the money. Double-digit billion is like $100 million protocol, which seems to be a relatively mid-cap in the crypto space, going to 10 billion. And 10 billion potentially seems tame. 10 billion, if there's $1 trillion in this space, in stable coins, the TVL and market caps aren't one-to-one with stable coins. They're multiples. So the total market capitalization of the space can get freaking weird. If the stable coins go 10x on the money, you guys have no idea what's coming. So I argue that is probably the most reasonable way to engage with these markets, especially from a sustainable perspective. No insanity, little emotion required, time and patience, and digesting the mechanics of the space. Folks acting like this is going to turn around and go in reverse. Crypto space is going to be no more. It's going to go multiples upon multiples, and it's going to make people's eyes bleed. And then the real cope is from Meat Space, that they didn't buy all the crash businesses after crypto.com. And we'll all laugh as the meme coins do insane numbers, as the middle class continues to get hollowed out. Folks that don't have a rich narrative are going to engage with what they can understand. And I don't mean that in a demeaning way. I mean that in a realistic way. I offer a story that the majority cannot and probably will never understand. Most people don't want to understand the way the financial system works. They want to think that they're putting money in a bank account. And dollars aren't even money. It's not even close. And in that regard, they're still blue pilled. If you don't understand the way the financial system works, you're not red pilled. You're not you not have woken up to the reality of what this system is as a system of control. And that's the only chance you have, in my opinion, to really outperform, to really do something that the majority cannot do. And why does that all make sense? Because that's just finance. And the minority always outperform because they understand the way things work, and the majority don't. So it just makes sense. So every one of my arguments that seems, you know, exuberant or grandiose is literally just supported by the shit that's right in front of our face. The majority don't win. They get left behind. The minority win because they understand and accept and process and digest the way the system works. Red pill the shit out of themselves. Good morning, sir. Gabriel's in the house. Hello. Askar, hello. Leandro, good morning. Nice to catch you live. Ron, Ron Skapansky, I got you. Raul, hello. Good afternoon. What are you doing with your W? Heck of an airdrop. Looks, it's running up. I got the charts up because I was a little, you get tempted to dump your airdrop. I have a couple of different ones, and I'm not sure where to get the best price data from, but that should bottom from a 5-minute standpoint. At least this is a presentation here. That's wormhole tether, but that says at $1.40. And then you go over to here and you look on chain. So I'm not quite sure of the pricing. $1.40. This says literally 9 cents. I'm confused a little bit. But there's one thing that I know is that the drop was on Salana, and that seems consistent. I'm not liquidating it right now. So I think Solana, this is on Solana. And the last thing the majority of actors on Solana do is engage rationally. They're literally going to turn it into a meme coin. 2.12 bill fully diluted, 2 mil market cap, 2 bill market cap. They're turning it into a meme coin. Sure as hell, I'm not going to right curve this one. In the end, the only purpose of it is to dump it. And if these folks are going to run it up in price, have at it. I mean, frankly, Jupe has done pretty remarkable as well. What's Jupe running at? Jupe has bumped up too. If they could buy it, they're just going to buy it, and they don't care why they're going to buy it. and I'm okay with that. If I could, if these sellable tokens, because that's all they are going to go 10x on the money on Solana. Look at this shit. This looks great. Looks like a fucking meme coin. All right, so I'll let it run. I'll take 10x on the money. I don't complain. I wouldn't be complaining about that. I've never kept, I've kept I think bear market, I had like $200 worth of Solana. And the Salana has obviously went 10x on the money or whatever, and now that's worth whatever I have left for. I only had it was $8. Solana was $8, and I had two Solana. I didn't even have $100. I had like $20 worth of Solana. So that's now $400. Bonk is from Hero, which comes in actually as a decent rev stream. Pretty volatile, 350. A cat. Clearly, this was some sort of airdrop. And Jupe is, I mean, this that's pretty cool because all of that was just poof out of thin air. I'll let the DGens run it up. I have no work to do. Not my prerogative. Not my wheelhouse. I'm not going to fight it though. I think that's a good question on a day like today. I think they run it. They don't care about market cap. It's not rational. Market caps should be a relative thing, but it's irrelevant because most people don't look at CoinGecko. They don't understand comps from like a real estate perspective. So take your understanding of what's going on in the space and drop all the intelligent analysis. Let it sit. That's okay. That's the deal. Askar, Noah, can you explain why stocks usually crash after rate cuts? Should we worry about coming rate cuts? Well, historically, stocks crash on rate cuts, and you could look at it from not a mechanical standpoint, but from a psychological standpoint. They're cutting rates because shit's getting bad. Things are rolling over. And once anything starts to roll over, it's a cascade effect. You have to experience the end of 2021 in crypto or the end of early 2018 when things started to roll over to know what it's like when shit's really rolling over. Everything is momentum. All of pricing is consensus. It's agreed upon value. And breadth is a big deal with regard to the rise of fear. If some shit stops going up, everyone will start to get afraid that it's going to start going down. And price action is very much a self-fulfilling prophecy. So once it starts to go down, it keeps going down. And then it's not buy the dip, it's sell the rip. So that's why stocks crash when historically rate cuts occurred. Now there's actually great arguments why this time is different. And we looked at two critical pieces of the biggest data possible of why it's different. And it's a big thing to say that the structure of the system is different. I don't think things roll over when stocks crash this time for reasons. Because the structure of the bond market's different, the fiscally dominant regime, and gold is screaming that we're past the Rubicon of it being different this time. It's still imperative to understand the way it was, the way the world was, to get a sense of the adjustment that can potentially occur in the world that is becoming. And it's going to be a stark adjustment where stocks go up and to the right. That becomes the savings vehicle. And we see this in emerging markets. Look at Venezuela. Look at Argentina. The stock markets are completely vertical. They just go up, 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 and up. So these are normal things. And they will become increasingly normal as more and more people see and feel confident that the structure of the system is past the Rubicon, the point of no return, where they can't cut interest rates because then limited supply natural resources drive consumer price inflation, and then politicians don't get reelected. Or when they don't cut interest rates and interest expense starts to eat into capacity for the government to spend money, and they have trouble financing, fiscal congressional bills. And then politicians don't get reelected. So politicians will do what they need to do to get reelected. It's just a matter of existentiality, is it not? So, yes, historically you should be worried about rate cuts, but look at the data. I've seen data on X dealing with restaurants, and it's a catastrophe. We haven't seen a decrease in restaurant consumption like this since 2020 and 2008. Nominally, if you look at Fred data, it's up and to the right. But if you look at the amount of volume and activity in these businesses, it's a catastrophe. So there's your disparity. You get the disparity in the data as well, where certain data says it's a catastrophe and certain data says it's incredible. And clearly it's just fine for the premium restaurants. Go down to the big steakhouses, the big sushi restaurants, Nobu in Miami, and people are spending $1,000 on dinner. Nominally. The wealthy don't get left behind. The wealthy make more. They end up owning everything. And that's the system in which we exist. Don't fight it. Understand it. Understand the mechanics of it. I don't expect so they're dying to cut rates. The interesting thing is the story's flipped for the Fed right now. They are itching and itching and itching and itching to cut rates. They desperately need to cut rates because every single person at the Treasury Department and likely in Congress as well, if not the executive branch, is saying, you got to fucking cut rates, dude. We got to issue all this shit out of Treasury, and you still got rates at this level. And they don't want to, but they're going to be pressured into. And these elevated rates are going to cause all sorts of distortions in the composition of the global money supply, and even more so the currency supply. Because bonds are money and bonds print currency under favorable conditions. And these particular conditions that we have, these elevated rates, are going to give bankers the biggest incentive they've had in part of a generation to go sell products, financial products, including credit and derivatives. Not foreign exchange. They don't sell foreign exchange. But they're going to sure as hell love to sell those derivatives. Cranking out leverage on 4% plus. Woo! Bankers are going to be in banker heaven. And credit. As much as it's harder to service a 4% loan versus a 0.25%, that 4% loan has a great chance of making money in an environment that's flush with cash. 4% is not much of a hurdle rate. You're not going to do it necessarily in the restaurant business. They have slim margins, 2-3%, whatever. Fun fact, did you know that the biggest winner in a restaurant is soda? They got the biggest margins. So, but there's plenty of businesses that clear more than 4%. Maybe not real estate and certainly not rentals. But that becomes the hurdle rate, and that's just part of the business plan, part of the calculation for the enterprise and why the debt is being taken on. So I'm not too worried about rate cuts this time. Basically, the market's screaming up and to the right, absent geopolitical conflict, of which it looks like we're going to have geopolitical conflict also. So path is always going to be bumpy. You will always have a story where the path is with landmines. The system is always ready to implode. The only reason it doesn't implode is because it is a managed financial system at both the money and the currency level. The banks, the commercial banks, the central banks, and now the private money, the private lenders, private credit facilities, they all work in concert. And that the largest actors in those sectors, they have red phones, little red phones, to respond to the needs that regulators see in the system to adjust, to account for emergency. Emergency what? Liquidity. That's their whole job, is to resolve or to manage this volatility such that the system continues and you don't have chaos, you don't have disorder, you don't have civil unrest, and you don't have a post-apocalyptic scenario. And they have a shitload of social disorder. So how do you cure social disorder? At least the only thing that a politician can do. You finance. You finance social civility. So things will get weird and, like WEF type narratives, 10, 20, 30, 2050, maybe sooner. But the point is, it's not now, it's not today. The things we're discussing are about today and where we're heading in the short term. And you cannot change a system. It's not like replacing a light bulb. These processes will take decades for the general public of countries to accept. I mean, the matrix is ever relevant, and all the general public has to do is accept things at a mere subconscious level. Wonderful metaphors in the original, the original movie. They nailed it, those Wachowski brothers. Absolutely nailed it. And regulators and organizations will continue to test us on what we will accept. So be blue-pilled or understand the system and be a navigator, a sailor. You can do well either way. We have to make our choices and we live with our choices. And the question becomes, how do you want to live? 40-year-old man, we're thinking about blood pressure and fucking cholesterol and shit. And how long we could live could take care of our kids and so on and so forth. And very different things we think about compared to 20s and 30s. And nowadays, when you get older, you're going to want to be calm. If folks like Dan on the stream will very clearly remember me talking in 22, especially on our Discord forum, the most rational community in the crypto space. And I'm going to be calm when this market cycle comes. And I think I underestimated how calm I actually am and how slow and how much time I take to make decisions. I wouldn't mind acquiring a position. I said last night on Twitter, if I see a discount, and I'm looking, certainly looking. I got my eyes peeled on Aerodrome, but I'm not buying at this price. And a statement I'll make is I'm not going to buy someone else's 10x. And a lot of people may actually call that arrogant. And but I'm not going to buy someone else's 10x. Not that they don't deserve the 10x, because that's what you're doing. If you're going to buy it from them, you're paying them 10x on their money. It's not a position of arrogance. I would argue this is being said from a position of it's not personal, it's business. If anything, it's just quantitative. Why would I not pay you 10x on the money? Because I don't have to. Because there's other options. There's other opportunities. And this is something financial. So this is financial is personal. Financial has nothing to do with other people. You're all listening to me not to see picks, not to see what to buy. It's the last thing I've ever said to anyone. Anything I've ever said is stories, ideas, and how these systems work. So that's why there's always another opportunity, because there's plenty of systems. Cleopatra I've been looking at as well, up on Mantle. And I found this on Mantle, Merchant Joe, and I got a kick out of it. I moved my Joe over there because you stake it for Mo. So Joe, I absolutely love Trader Joe's branding. It's got to be the best branding ever. Trader Joe, Merchant Mo. That's so goddamn good. So Mantle's getting up in the Stargate, so that's cool. So Mantle is coming on the radar, in my opinion. Enough so that the bridge is relatively painless, and the bridge for Joe is their Stargate. That's what Stargate was designed to do. So, folks, we're underestimating the scale and scope of where these chains are heading. I've said repeatedly that at some point you won't know what chain you're operating on and won't need to know, but now you can know what chain you're operating on, and you do have these opportunities, and that's how early you are. At some point, these chains are going to explode. 10,000 chains. You won't even be able to keep up with the amount of chains, and every corporation will have a damn chain. Why? Because they can. There's stuff like what Circuit or I, I follow them on X, and you could literally it's like degen chain. You can literally spin up an arbitrum orb, settling on base with DA on another chain, and literally if folks are scrambling over Celestia, there's going to be 1,000 DA chains and 1,000 settlement chains and 1,000 optimistic rollups and 1,000 arbitrum orbits. The scale and scope is just not being expressed as clearly as I need to express it. Don't have to do much work, and this space is going to do a lot of people very well. Trantaloid, did you see Andre's post about Athena concerns? No, I did not. I should check that out. Um, Frankly, it's Binance Smart Chain, and I would not be surprised to see concerns. Uh, Maybe I could actually take a look at that with you guys. Why don't you post that link, and I wouldn't mind reading it with the community today. We'll take a peek. Very interesting what he's up to and what he unleashed with the solidly code or the solidly idea. Thank you for telling your story. It helps keep me informed and sufficiently diversified. Sufficiently. It's a threshold, isn't it? Excessively diversified diminishes potential, and excessive concentration also diminishes potential. But the concentration is what makes the biggest returns. So isn't that a sliding scale? And in the end, you can only ever measure how well you did, and from hindsight, from the looking back. VStream goes live for VEFXS starting soon. Should be big. If it goes big, are we going to be surprised? It's all been obvious for quite some time, and for many, it's only obvious when it actually happens, and then they're not the early ones. So I expect it to be very big. Look at the amount of chains that we've talked about and the scale and scope of what Frax has in mind with what they're capable of, going cross-chain with tools like CCIP and Stargate and Layer Zero, and literally their bridge technology, and roll this clock forward 10 years. It's going to be quite interesting. Sergio present. Hallucian, good morning. I have a friend who just tuned in for the first time, who's big into S&P and not so much into crypto. Can you please restate your thesis as to why you're the opposite? Well, the S&P is an expression of the real economy. You have two economies on planet Earth, the real economy and the financial economy. The real economy, from a breadth, BREADTH, the potential for the system to expand significantly, I think is weak. Where's the commercial bank lending? Nominally, the S&P has grown over time, but it's not keeping up a currency supply, and credit's not expanding at the banking level. In fact, I would think that credit is going to continue to remain constrained in the real economy. It has to remain constrained to control consumer price inflation. At least that's the argument that the Fed would make. And that's going to limit or dampen the potential for cash to circulate in the real economy, especially of the United States. The financial economy is a whole other story. The amount of money moving through banks, the amount of money moving offshore, the amount of money being printed offshore using collateral, U.S. long-dated debt, being printed, used as collateral for credit in foreign banks, the Eurodollar market. So the financial economy and the real economy, two separate markets. I just don't see the potential for growth. And that's exactly what like Luke Roman talks about all the time is you need like a technological revolution. Like fusion or AI that, and all of a sudden there's literally, you know, 10 million, 50 million jobs replaced in the U.S. with AI, freeing up 50 million workers. And now you have like a revolution of employment. Something big, something structural. So the S&P is not the expression I want. And aside from that, it's the instrument that disgusts me. The notion of a stock. The stock market has become, in so many regards, meme coins, an expression of social media and trends and gambling and speculation. And that's literally just the broad statement I can make about all stocks. Anything that you interact with from a brokerage account, a Fidelity account, Merrill Lynch, whatever digital user interface you use. So it's all of NASDAQ, all the S&P, the Russell. The Russell's going to be boring as fuck. I mean, it was like 90% of the shit in the Russell is suffering. You could look at what's below the long-term moving averages, and it's the stock market's basically destroyed. It's the few in the stock market and the concentration that has occurred, especially in the NASDAQ, that has resulted in those indices, those ETFs, going up and to the right. It's because they're adjusting the composition of the ETF to better suit the price point of the ETF. It's all a manipulation. So the biggest reason I don't like stocks is because I like to own business. And I want to own business passive. Why? Because passive doesn't do work. Active requires work. I want to make money not doing work. It's actually a really simple statement that seems complicated to many. I just want to make money not doing work. Go figure. And you can't do that with stocks because what do you have with a stock? You have an instrument that you could buy and you could sell. The yields on so much shit are bullshit. What the fuck am I going to do with a 0.25%? What am I going to do with a 0.5%, 1%? What am I going to go to realty income for 4.5%? All right, fine. You have $10 million, get 4.5%, you're good to go. You know what it takes to get 10 mil? And then you would literally, anyway, point being, governance is shit. You have no capacity to influence the outcome or the behavior of corporations as a retail investor. Buffett always said, you own a stock, you own a company. At his size, yes. When you could buy a third of a company, you don't get stock. You don't get just stock. You get a seat at the board. you govern the company. Your choices dictate the behavior of the company. And then the yield that gets paid to stockholders is placation. Pay your human resources, give them bonuses, keep them employed, pay your real estate expenses, pay your human resources, benefits, insurance, pay your executives. And then, with whatever shit is left over, do a little bit of research and development, do a shitload of buybacks to manage the monetary policy, corporate QE. And then a little bit of a sprinkling for the retail plebs that buy the stocks. So that's a broad stereotypical statement about the stock market, all of it, S&P, NASDAQ, whatever. But that's a reasonable statement because that is mostly what is the case. In the crypto markets, it doesn't exist. These companies, when you look at them as companies, have zero debt, zero real estate, zero human resource expenses, zero debt. Value investors, the first thing they look to is the balance sheet of a corporation to see how healthy they are, to try and assess what a proper forward-looking P&E is. Is the company in a position to grow into the future? Imagine seeing a company with zero debt, zero human resources, cranking out $1 million+ a week in revenue, $365 million a year run rate, with zero human resources and zero real estate and zero debt. And that's literally boring ass curve finance. Holy shit. So this is the completely missed opportunity from an early perspective for meat space, especially traditional value investors. I mean, that's literally a traditional value inspection. If you look at the balance sheet, and it can get complicated because you could talk about curves, issuance, and deficit spending, and how does their balance sheet compute. And we're still digesting that entire narrative, but I've told that story in the sense of nation state and deficit spending and sterilization with the petrodollar regime. And look at what has occurred with the solidly forks, the alignment of interest, and how 100% of LP and LP for the traditional finance folks in the room, and LP is just like a market maker, old school Wall Street, or the big banks that manage their own liquidity between currency pairs. So that's what LPing is on AMMs, which is basically crypto exchanges, which I define as an FX market, foreign exchange market. So on solidly forks, um, governance gets 100% of all LP revenue, which gets distributed pro rata, your percent ownership of supply. And then the protocols use deficit spending to incentivize and finance liquidity depth, so that you can see the circular flow there of incentives. Everyone's incentivized to own a piece of this business to gain access to the revenue generated by the FX market, which consumes the deficit spending that is used to finance the depth of that FX market. All right, so let it churn. Let it go up and down 10, 20, 30%. At some point, the whole system expands. And that's why I talk about how bonds are turned into currency, and to understand the Eurodollar market and what happens when $100 trillion floods the global financial system. And what if you get 1 or 2% that flow into crypto markets? I mean, that's literally the base case. That's the base case for like everyone. How's there not going to be $1 trillion across the DeFi landscape? It's less than a 10x from where we are. Do you know what happens to 10 million, 50 million, $100 million protocols when $800 billion flows into space in dollars? And that's market cap. So the market cap is multiples of total dollars sloshing around, total dollar supply. And that's, mid cap in meat space land, in equity markets. What's mid cap? Is $1 billion is small cap? I don't know. I put that on social media at times, and the relative scaling is pretty stark compared to what people think mid caps are in crypto markets. People think a couple $100 million in crypto markets is mid cap. I think that's going to change when top 100 is double digit bill. Mid cap's going to be what, a bill? A bill in traditional finance is a freaking unicorn. That's probably not anymore. The whole scale and scope of things is going to change over the years as the composition, the overall depth of the currency supply of the frickin' planet expands into the future. Hope that helps. If your friend has any questions, I'm more than happy to answer them. That was a decent general introduction. Obviously something most of you have heard many a times at this point. Hello, friend of ARL Hallucian. Yes, indeedy. I watch it. I'm not going to get the price I want. And I am not going to buy someone's 100x on the money. And that's okay. That's okay. There's other opportunities. And my chosen opportunity was Ramsey's at a mill market cap when I saw it. So I acquired a position at a mill market cap. A mill, I mean, literally imagine talking to traditional finance boys, mill market cap, and the comp is 500 mil, and there's more liquidity on Arbitrum than base. It's just such a stark comp. I mean, literally 4.71 mil when the comp is 545 mil. It is the same code. It is the same protocol and a different network, which is akin to like uh, pick two countries, U.S. versus Canada. Just one's in U.S., one's versus Canada. That's what base is relative to Arbitrum. It's two networks, which is akin to cross-border. The metaphor holds. Yet there's four times the amount of liquidity on Arbitrum. If you go over to stablecoins and we take a look at Arbitrum for a little update action, $3.39 billion on Arbitrum, and on base is $1.4 billion, which continues to scream ahead. Here, watch my narrative get invalidated to a degree where base tops Arbitrum, but we follow the data. And when the data hits, you adjust the narrative, and the data presents opportunity. So maybe base does do that. And then we'll be here telling a different story. And that's okay. And you don't have to fear changing your story. You just respond to the data. I am Dean. Hey. Amir's in the house. Much a pleasure. Did you buy love? Yeah, I'm good. Good morning, Cap. Some macro cues today. Hit it. Let's do it. Oh, damn, I got a phone call in a little bit. I'm going to be late to it. I want to hit your comments. Interest rate incentivizes banks to lend, but disincentivizes borrowers to borrow. Not necessarily. Interest rate on debt is a hurdle rate. So, for instance, if you're going to do a real estate project that's going to get you 50% of the money because you already locked in the sales, clearly you get to borrow at 4 or 5%. You don't give a crap. So that's what letters of intent are with regard to business plans and signing of forward-looking deals. This is very common in manufacturing and mining. Like a new mine for resources, you sign your deals in advance. So 4% ain't shit, considering business and the potential returns you could have from a business perspective. So there's very much not much of a difference in incentives to borrow, except now we're entering a world where there's a massive incentive at the banker level to lend. What high interest rate increase global and what high, decrease domestic liquidity? Well, liquidity liquidity is that abstract phenomena that we all talk about. Liquidity, I would broadly say, like Mike Howe says, it's balance sheet capacity, which is a capacity to lend. Um, capacity is, I generally talk about liquidity in terms of currency supply. Like, look, there's $1.45 billion worth of liquidity on base, which means in some shape or form, something can be sold for some of these currency units that can be used to purchase something else. So this is the amount of currency supply that can contribute to financial activity. If 100% of everything on base was sold, the total amount of dollars it could be sold for is $1.45 billion. Because that's all the amount of dollars that can be bought. And that's not considering exogenous flows, of course, but in a closed system, that would be exactly the case. Um, so domestic liquidity in the real economy broadly is the capacity for commercial banks to extend credit. And their balance sheets are constrained because the collateral on their books has depreciated. And the only reason things are working is their hold to maturity and accounting rules says they can continue operating, but they just don't have the capacity to lend like they did when before they bought all their bonds in 2020 at 0% more or less. So now they're constrained because all those bonds, all that collateral, all that balance sheet components have depreciated. So a lowering of interest rates frees up capital or balance sheets capacity in the real economy. Financial economy is a different story, and that's private credit. And that's exactly what we're doing with regard to stable coins. This is all private credit. All of this is give me collateral and I will give you dollars. You have to understand what is a dollar. These stable coins are frankly dollars. The second everyone said a bank deposit was a settlement currency, that the bank deposit is a dollar, but it's not a dollar bill, but it's a dollar, and that's the biggest hurdle to be red pilled about the nature of the financial system. What is a dollar? What is currency versus money? So if you have a stable coin that's and it's a dollar, it's a dollar. It's actually a dollar. It's just as much as a dollar as a bank dollar. The only difference is the backdrop of regulation and pipes and infrastructure to support its capacity to be worth a dollar. A dollar bank deposit is regulated to be a dollar. But guess what? In crypto markets, that's the case, and the strongest of protocols have regulations or monetary policies in place to make them a dollar. And that's something we've been talking about very much with regard to interest rates. Now, interest rates control the capacity of these dollar printing regimes to maintain the integrity of their system, because the integrity of that dollar matters much more than the amount of dollars that they're able to print. Because the integrity of that dollar implies the amount of dollars they can print in the future. The second trust is lost, the protocol will decrease in consumption into the future. And lendiness says that as long as the protocol continues to work and protect the value of that dollar, it will get consumed more and more and more into the future. And all an interest rate is a hurdle. There are plenty of people paying 30, 40, 50, 60% interest on stablecoins for a reason, because they could earn more than 30, 40, 50, 60% interest or returns on investments. And that's called a carry. And the carry holds until it's invalidated. If their investments no longer are earning more than their interest payments, they have to reverse the trade and unwind the trade. And they do. And sometimes they're forced to, because the interest rates need to adjust. They need to go up, up, and up to force people to rebuy the stablecoin to protect its value, being a dollar. That's why CRVUSD is an extraordinary product. And frankly, for that matter, Fraxlend does something very similar. And I think more and more protocols are going to have that dynamic, aggressive monetary policy more and more. And we have yet to see the true stablecoin explosion that has to come, because these systems produce very, very stable dollars, because all you have is interest rates. And that whole redemption model, no, that's old world way of thinking. That's liquidation way of thinking, and that's not going to cut it in a high-speed world. But interest rates will. If someone's starting to pay 60, 70, 80%, they're going to buy back the stable coins and repay their debt, which will repeg a stable coin from 0.995 to 0.998 to 0.999. It puts the bid. Higher interest rates puts the bid. Lower interest rates encourages people to borrow. And what are people going to do with the borrowed stablecoin? They're going to sell it. That puts the ask, and people are selling the stablecoin. So adjust the interest rate, and you're able to adjust the relative bid and ask on the stablecoin to manage the frickin' peg. Own the peg. That's how you protect infrastructure over the debtor, and that's how you do something that's innovative over anything they've ever done in traditional finance. It's a big deal. Why high interest rates? I think I hit that. If high interest rates are increasing global liquidity, why are we waiting for interest rate cuts? We're not. I'm not. Higher interest rates are going to significantly increase global liquidity as Treasury prints money this year. Understand, my terminologies are very specific when and how I'm using them. Treasury prints money. Money prints currency under favorable conditions. And those favorable conditions are much more favorable with a higher interest rate environment. Lower interest rates are for the domestic U.S. real economy, the commercial banks. Higher interest rates are for private capital, private financing, private credit, and that's global, where the dollars are printed offshore internationally. I don't know who's waiting for interest rate cuts. I am very much looking forward to ending the year at 4.5, 4.75, 5%, or no rate cuts. And I think that is what causes this time to be quite different in many regards. Be very specific when I say it's different this time versus it's the same, and it is always granular. It's like how I've always said, inflation is a relative terminology. Inflation is relative to something: consumer price inflation, currency inflation, real estate inflation. It's an adjective, an adverb. It's describing something. So it's the same thing with uh, uh, what was my point? It, oh, it's relative, and the interest rates, I don't know, whatever. I hope you got a point out of what I was just trying to say. Wachowski sisters now apparently, yeah. Oh oh, maybe that's an interesting story. But at least the most recent one, the fourth one, was the sister. Did they really do that kind of adjustment? Uh, this is a very interesting world we're heading into. Azure Unidex has been paying out dividends, but now they are changing the payout structure where the dividend paying token is molten. One way conversion, Unidex becomes molten. There's a lot of protocols. That's why I don't really talk protocols. That's why I really try and talk about concepts and structure and all what goes into these businesses. And so, okay, maybe that's an expression. So a portfolio is an expression of what you see as being something significant in the future. And if you see that as being something significant in the future, that's cool. That's okay. Think about scale and scope, what networks it has exposure to, how much dollar supply is on the networks that it has exposure to. Think about who's using it, who's integrating with it, and all of these things go into a portfolio component. It's not for me to say that I'm interested in something or not interested in something. It's for everyone to define that or state that to themselves. Molten is an EVML2. There's going to be 10,000 EVML2s. Hope that helps, Asher. All roads seem to lead to mainnet, and mainnet roads lead to ETH. So the statement that is comfortable to be made is that from a dollar supply standpoint. $78 billion on Ethereum mainnet, and if you compare that to any other network other than Tron, mainnet dwarfs everything in size and liquidity and total dollar supply, and that's a big deal. And that is a statement of the individuals and where the dollars are trusted most, where the dollars, these are dollars. This isn't Ethereum. This isn't a value of a token. These are dollars. So where people are trusting their capacity to buy things, and that's everything. And this means everything. That value means everything. So what you said, Mikma, is the truth. Diego, I know I'm struggling about V33 optimizer. I don't know if keeping my VRAM or going in need RAM. Um, the only argument that I have with myself is owning the infrastructure low level versus owning a derivative, because need RAM is a derivative. Need RAM can be sold. So if you can't sell something, now you have to psychologically consider that choice, that option. Do you sell it? Do you sell it under what condition? And that increases the complexity of capital management. Now, unfortunately, I can't convert a VE-RAM position to need RAM, which does kind of give me that optionality, but I very much prefer systems where I don't have that optionality. I prefer not having a capacity to sell. Now that allows me to think of a position as a purchase rather than a position. And that also presents interesting things from bookkeeping reporting type of perspective. If you can't sell it, it's like owning a business. But a business that's not liquidatable. At least that's in metaphoric terms. So that means something to me, and it means something certainly semantically. The structure of describing what I just said has meaning, and I want less work to do. So the only way I can have less work to do is to seek out opportunities where I don't have to think as much, and I cannot sell something. That's a big deal to me. Um, that does not necessarily help your question, but at least that's a little bit of insight into the way I think about capital management, portfolio management. FXS down 14% past 7 days, and opportunity. Obviously, that's a subjective assessment of what you see in the data, what you see in how much capital you have, and what look. You put $1,000 into Frax, and let's just run some numbers real quick. Spec and position size. Uh, that's not what I'm looking for. I want market cap. Hey, let's go over here so we can see chart data too. 25 mil liquidity. This is appropriate. So Frax is at a $500 million market cap. So what are the odds of them landing in the top 100? Double-digit billions. What are the odds of them landing in top 20? Triple-digit billions. What are the odds? What is the scale and scope? How many networks are they working with? What products are they dealing with? I mean, some of these things are actually quite intriguing. They're dealing with stablecoins. They're dealing with liquidity. They're dealing with incentive financing. And their scale and scope is pretty much everything because they're directly integrated with Stargate and they go to all chains because they're omni-chain, literally with their own optimistic super chain, which basically means they have a capacity to draw on optimism's incentive regime. So, I'm not here to answer those questions, but pretty damn interesting. And that is the type of conversation I've had with myself over the years and why I opted for a position I cannot sell all those years ago. And I've been with them for years, years. Um, could probably go out to the weekly chart to have a decent perspective. So I watched Frax go from my entry maybe around 280, give or take, somewhere around here, up to $52. But I had no capacity to sell them. So from my perspective, it wasn't something to even consider from a sales point. It wasn't a position. I own a business, and my hope is that the business survives, and my hope is that the business produces revenue, and my hope is that the business expands and grows and produces more revenue. And what have we experienced thus far? A higher low. Okay, that's pretty cool. And structurally, we actually have a higher low after 2022 lows, which was ironically a triple bottom because there's no such things as triple bottoms and triple tops. But apparently there was a triple bottom here, so go figure. Kind of weird. Higher low, higher low. Let's see if we produce a higher low. I have no capacity to tell whether it goes down or up from here. I have all the hope in the world that it doesn't go back to $2.80, and I, that's it. I sit back and watch, just like all of you. But I think we've said very reasonable things about it over the years, and as you said, it's down. Is that mispriced? If it's mispriced and it goes up in the future, turns out to be a great buy. If it's not mispriced and it goes down, all right, it was probably good to not buy it. All I do is state rational statements, and it's for everyone to process as best possible. Sir, you also need to take a look at the Nile. Yes, indeed, I've been meaning to. Getting a grant from Consensus and Linnea is a good chain. Yeah, I've been meaning to check that out. So Clio's two chains I've been meaning to. So Clio on Mantle, uh, uh, trader merchant Mo currently has. There's no liquidity on the damn chain, so what the hell am I talking about? It's all speculative. I fortunately have a little bit of exposure on Mantle vis-a-vis what will become of the airdrop from merchant Mo. I've contemplated Cleos. It doesn't really fit into XYZ, but maybe it's speculative, and sure as hell is something I've done with Frax because that's been speculative cash flow. Hasn't produced much cash flow, so I don't discount that kind of exposure. And let's look at the Nile. Is it Nile? Yeah, 212K liquidity. I mean, it's at 383 mil. It looks structurally very nice, and it's probably catching a nice bid for a variety of reasons. Can I acquire appropriate position size? I'd have a smaller position size. It's up 65% in 24 hours. It does look like it's going to break out. It's I cannot acquire the same. I don't have enough capital for position size like I did with Ramsey's. Ramsey's I acquired at like 900K, $1 million market cap. So this is almost 4 times that. So I would need 4 times the amount of capital that I deployed to Ramsey's, and I don't have that. So yeah, it'd be nice to have exposure to it. I don't think I could afford the position size I would want, and that's generally where I'm at with it. The chart looks great. I wish Ramsey's was doing this. I think it will, though. Look at all the amount of dollars that are on Arbitrum. So that's what it comes down to right about now, Gabriel. I woke up this morning looking for opportunities, but I don't think I have enough cash. I need a lower market cap. I need something that's increasingly mispriced. And I say that with about maybe 30 grand that I could throw off onto something, and that's not so. It's what if I throw off 38,000 is 1% supply, 1% of the market cap. And I often say if you're going to own something, you really want to own it. So if you could own supply, that's a big thing. And I don't think I can own enough of the supply. Uh, and what's the point? It's excess diversification into an exposure that I already have, where I own 2.5% of supply. That was a heck of a mispriced situation for Ramsey's. 2.5% of supply. I don't know how the hell I got 2.5% of supply, but I don't have enough. It is what it is. I don't. Something I will continue to think about though. Crypto Jake, good morning, Cap. Hello. Sorry if you went over this. I'll go back and look if it was discussed already. Thoughts on ENA sustainability? Sure as hell going to introduce a lot of volatility, a lot of risk, a lot of controversy. Stable or not, you'll only ever know from hindsight. It screams Luna 2.0 to everybody. But what are you going to do? Frankly, it'll create a whole lot of volatility. And what do we do with volatility? We capture fees. So that's generally the perspective I have right now. Not too keen on another, collapse of credit like we had in 2022. But that was also a lot of meat space, that kind of leverage. I don't know. We'll see what happens. There's nothing else we can do. Feels like FXS will be so obvious in hindsight when it's at 100. I mean, that's generally a statement I think that's relatively tame. 20x on the money. It's a couple of bill. And, I see top 100 being double-digit bill. I think the stable coins are the big product of the crypto markets. And I think they're very much underestimated, not just from the crypto market perspective. I think they're going to be really underestimated from a TradFi perspective. Because where do you go for credit when the commercial banks can't lend you? Now, the big boys in the financial economy will be able to get credit because they could post a huge amount of collateral. They could post collateral, not necessarily a huge amount, but that's also going to be the case. It will be a huge amount, 10.8 trill worth of fresh collateral. So where does everyone go for credit if the banks, one, don't have the balance sheet capacity, or two, they just won't lend to you? And it turns out that crypto markets, anyone could get credit, no matter what, permissionlessly. So the crypto space is a place for geopolitical, regulatory, geographic arbitrage, interest rate arbitrage. I think this is a very interesting place to be. You can farm, to be honest. The APRs are great. I was thinking about that today with the assets that I have, but frankly, the assets are on raw. So you can see the complexity there. I literally have the assets in an LP type of position on Raw, which is part of their kingdom. So why would I migrate from Raw to there just to LP? I probably already have the exposure I need, Gabriel. But you can see the train of thought I have, and I consider these types of things, and I'm like, in the end, that is a great conclusion to a conversation with oneself. I probably don't need to do anything, even though it does look interesting. And that's okay. And even if this thing goes 10x on the money, that's okay. Why? Because the immediate emotional response is, damn, I should have bought it. Therefore, the appropriate emotional response and the preparedness needs to be, that's okay. It's okay to miss an opportunity. What's not okay is to miss all opportunities. And that's the whole point of a portfolio, to have exposure such that you're going to catch at least something. It's not going to be all things, but it's going to be something. DA Advisors in the house. Idan's in the house. Much pleasure. How's the stream? Was doing some stuff. We'll start watching it tonight on repeat till next one as usual, my man. Appreciate you as always. Athletic, hey Cap, when does the inflation die off on Curve? It's already died off. I believe Curve is less inflationary than Bitcoin at this point. Clearly, that's going to get interesting towards the end of the year. We got the Bitcoin halving coming up in less than a month, and clearly Curve's emission supply die off in August. But it's currently less inflationary than Bitcoin. All of the recycling, all of the sterilization, it's the petrodollar. That's what they built. They needed a way to finance fiscal deficits. So they sold debt to Saudi Arabia, and the deal was that Saudi Arabia, they bought oil from Saudi Arabia, and the deal was that Saudi Arabia would park those dollars into treasury bills. And that's exactly what these boys built. That's what Michael built. It's the same circular flows. And I think these circular flows are very significant because they worked, and they do work. And the problem is traditional finance got perverted. So what fixes the perversion? Determinism and immutability, where they can't, certain degrees of the policy cannot change no matter what. And that's the revolution. Crypto Jake, Crypto, don't tell the masses about APRs. The APRs are, listen, you get a protocol that goes 100x on the money and is still producing 10%, 15% APR. That's what I see. Isn't that interesting? Because in traditional finance, yield is inversely proportional. There's an inverse correlation, especially with yields on like stocks. Price goes up, relative yield goes down because it's price per share or payment per share. In crypto markets, there's a degree of proportionality. Your principal appreciates. The yield isn't necessarily going down. It's not subjective. This is all quantitative. It's as defined in the contract. If the business increases revenues proportional to the appreciation of the price point of the asset, your asset goes 10, 100x on the money, and you were getting 30% before, and you're getting 20% after. So that is quite different from the mechanics of the cash flow opportunities that are historically available in equity markets. If I was joking, Cap, that's the game we play. Yeah, it's okay. You folks are able to watch on repeat if they want. But I appreciate all of you. More than you could probably imagine, because you've helped me get to where I am. My capacity to tell this story and to navigate these markets and be calm, cool, and collected and solidify the way I engage with these markets. So I appreciate you guys. Thank you very much. Wednesday, April 3rd at 1:51 p.m. Tell everyone to subscribe on either YouTube or X. At the party on Discord for the most rational community in the entire crypto space. I will see you guys on Friday. Y'all have a good one now. Peace.